Welcome back to Finance Supergirl, your ultimate source for investment insights. In today's episode, we're delving into the intriguing world of bond defaults. Have you ever wondered what happens when a bond defaults? Join us as we explore the implications of bond defaults and what it means for investors like you. Section 1. Understanding bond defaults. A bond default occurs when a bond issuer fails to meet its contractual obligations to make timely payments of principal and/or interest to bondholders. It's like when someone borrows money from you and fails to repay it as promised. Bond defaults can happen for various reasons, such as financial distress, economic downturns, changes in the issuer's creditworthiness, or unexpected events that impact the issuer's ability to fulfill its obligations. When a bond defaults, it can have significant consequences for both the issuer and the bondholders. Section 2. Effects on bondholders. When a bond defaults, bondholders face several potential consequences. Imagine you lent money to a friend, expecting them to pay you back with interest. If your friend fails to repay the borrowed amount and interest, you experience a loss of income. Similarly, when a bond defaults, bondholders miss out on the expected interest income they were supposed to receive. It's like missing a paycheck you were counting on to cover your expenses. In addition to the loss of income, bond defaults can lead to a decline in the bond's market value. Think of it like this. If you had a valuable item that suddenly lost its shine, its market value would likely decrease. When a bond defaults, investors reassess the issuer's creditworthiness and the likelihood of recovering their investment. This reassessment can cause the bond's price to drop as the market adjusts to reflect the increased risk associated with holding the defaulted bond. It's like a sudden drop in the value of your investment, leaving you with a diminished asset. Section 3. Recovery and resolution. Following a bond default, several paths can be taken to resolve the situation and potentially recover some or all of the investment. One option is for the issuer and bondholders to negotiate to restructure the bond's terms. It's like working out a new repayment plan with your friend who borrowed money from you. This could involve extending the maturity date, adjusting the interest rate, or even converting the bond into equity. The goal is to reach an agreement that benefits both the issuer and the bondholders, allowing the issuer to regain financial stability and providing some level of recovery for the bondholders. Another resolution option is the legal process. Bondholders may choose to take legal action against the issuer to enforce their rights and seek recovery of their investment. This typically involves filing a lawsuit to obtain a judgment against the issuer and potentially seizing the issuer's assets to satisfy the bondholder's claims. However, the legal process can be complex, time-consuming, and there is no guarantee of full recovery. It's like going to court to reclaim the money you lent to your friend, but the outcome may not always be favorable. Section 4. Examples of bond defaults. Let's explore some relatable examples of past bond defaults to understand their impact better. Imagine you loaned money to a small business that was thriving, only to find out later that the business faced financial difficulties and couldn't repay its debt. Similarly, in 2008, the iconic retailer Toys R Us defaulted on its bonds as it struggled to compete with online retailers and faced mounting debt. Bondholders experienced losses as the company filed for bankruptcy and ultimately closed its stores. This example highlights the challenges faced by traditional brick-and-mortar retailers in the digital age. Another example is the default of Puerto Rico's municipal bonds. Puerto Rico, a U.S. territory, faced a severe debt crisis, resulting in the default of its municipal bonds in 2016. The island's struggling economy and mounting debt burden made it difficult for the government to honor its obligations. Bondholders faced significant losses as Puerto Rico sought debt restructuring and fiscal reforms. This example demonstrates the risks associated with investing in municipal bonds issued by financially troubled entities. Section 5. Lessons and takeaways. The world of bond investing is not without its risks, and bond defaults serve as a stark reminder of these risks. One key lesson is the importance of diversification within bond portfolios. Imagine lending money to multiple friends instead of putting all your eggs in one basket. By spreading investments across different issuers, industries, and bond types, investors can mitigate the impact of any individual bond default on their overall portfolio. It's like building a safety net with multiple layers of protection. Another important takeaway is the need for thorough credit analysis and due diligence when investing in bonds. Just as you would carefully evaluate your friend's financial situation before lending them money, it's crucial to assess the issuer's financial health, creditworthiness, and the underlying risks associated with the bonds. By staying informed and conducting proper research, investors can better navigate the bond market. Conclusion. And that concludes our episode on bond defaults. Remember, bond defaults can have significant implications for both issuers and bondholders. If you find yourself facing a bond default, it's important to assess your options, consider the potential recovery avenues, and seek professional advice if needed. Stay tuned to Finance Supergirl for more valuable investment insights to empower your financial journey. Thank you for watching this episode of Finance Supergirl. If you found this content helpful, please give it a thumbs up and subscribe to our channel for more educational videos. Share your thoughts and experiences with bond defaults in the comments section below. Until next time, keep expanding your financial knowledge and empowering yourself on your wealth building journey. Note: the content provided is for informational purposes only and does not constitute financial advice. Always conduct thorough research and consult with a professional before making investment decisions.